Hello and welcome back. Whether by staving off financial meltdowns or ensuring that workers were paid when their firms' doors shuttered, economic officials, both from governments and central banks, helped to make lockdowns possible, and in so doing, saved millions of lives. Ladies and gentlemen, I'm delighted to welcome for this next panel 4 of the central bankers who are at the forefront of making those quick decisions. I'd now like to introduce the chair of the panel, Alessandra Galloni, editor-in-chief of Reuters. Alessandra, the floor is yours.
Hello, and thank you so much for this invitation. It is so great to be back at the ECB and in person with you, President Lagarde, and in the presence of Jay Powell, Chair of the Federal Reserve, Haruhiko, oh, I pronounced that wrong, Kuroda, apologies, Governor of the Bank of Japan. I even practiced and tried to get my best accent, and of course, Andrew Bailey, Governor of the Bank of England. A special pleasure to see you here, Governor Bailey. You made it in despite all the queues at the petrol pumps in the UK. So good to see you there in virtual presence. So when you all met here at this policy panel last year, it was still the dark days of the pandemic. There had been a temporary opening up in the summer of 2020, but by the autumn, the situation was dire. Many countries were once again in lockdown. Vaccine discoveries had begun, but only haltingly. And you all concurred that the global economy was facing a sea of uncertainty. However, monetary and fiscal authorities had already started delivering their forceful and undeniably successful coordination that began sowing the seeds of the economic recovery that we are seeing and have been seeing over the past few months. So here we are a year later. Vaccines have been rolled out in big parts of the world, of course, not in all parts of the world. Huge stimulus packages have achieved their objective. Countries have opened up again. And of course, there is a global economic recovery. So I thought that the first question I had for all of you is just to assess where we are today. Are the dark days of the pandemic really over? And can I get your assessment of the global economy over the next, let's say, 6 to 9 months? I'd like to begin there to set the stage for the rest of our conversation. And I think I'll go with the sun. So I will begin with Governor Kuroda, then I will go to President Lagarde, then Governor Bailey, and then Chair Powell. So Governor Kuroda, over to you.
Thank you. Thank you very much. The Japanese economy, of course, suffered a major contract by almost 10% from the previous year in the second quarter of last year. But since then, the economy has been gradually recovering or picking up. Now, 2 factors. One, the exports have been growing quite firmly on the back of expanding global digital-related demand. And second, the industrial production also recovered quite significantly. Now it's well over the level prevailed before the pandemic. On the other hand, consumption is still very weak. So this is the situation the Japanese economy still faced with, particularly the pandemic. But we think the economy will continue to recover and could reach the level prevailed before the pandemic at the end of this year or early next year. At this moment, the GDP is 2.7 percentage point below the level prevailed before the pandemic, but it is so close to the level. And we expect the GDP will reach the level prevailed before the pandemic, as I said, toward the end of this year or early next year. Two factors. One, the Japan's fully vaccinated rate has risen to nearly 60%, which is a level comparable to that in the United States and in Europe. You may know that the government decided to finish or the end the so-called emergency state declaration. So all in all, I think the consumption, which has been quite weak, would gradually step up. On the other hand, corporate sector enjoys fairly firm profit situation, which is translated into, again, fairly firm pickup in business fixed investment. So, as I said, the weak point is still consumption, but that is likely to recover in the coming months. So, although on the whole, this fiscal year, GDP growth may be quite small, but next year, the economy is likely to grow about 4% or something like that. So that is the situation the Japanese economy is faced now.
Great.
Thank you.
Thank you. Thank you, Governor Kuroda. Can I just turn to you, President Lagarde, now to give us your overall assessment of where we're heading for the next, let's say, 6 to 9 months?
Sure. And then good morning, afternoon, evening to my three colleagues. I'm delighted that you could join, and I hope that next year it's in Sintra that we'll get together. I said yesterday that we're back from the brink, but not completely out of the woods. And that is certainly the good translation of what we have seen, which was a very unusual recession followed by a very unusual recovery. And we are in that process of recovery. It's a very unusual recovery because it is the steepest recovery we have seen in the euro area since 1975. By the end of 21, the euro area will be back to pre-pandemic level and will move back to the trend that it was on before the pandemic hit us. So this recovery is very unusual, very rapid, and I would say that it has been largely attributable to the rapid vaccination campaign eventually, because now over 70% of the population over the age of 12 is fully vaccinated. It is attributable to the removal of the containment and the lockdown measures that have been virtually removed in all euro area, except for some social distance protection, such as the wearing of masks. But it has not stopped or reduced the activity both in manufacturing and in services, which have picked up significantly. And we have seen some interesting reaction on the part of those who suddenly were sort of relieved and released, in the sense that we have seen a pickup of purchases of goods in particular, which was very unusual. And of course, the services now has been seriously accelerating, and we're using all sorts of unusual instruments to try to measure that. Mobility measurements in particular are clearly showing that people are going back to consuming services, and sometimes more than they had before pandemic. But contrary to last year, where we said that there was a sea of uncertainty, the sea has receded somehow, but we still have uncertainty. And those uncertainty operate as a threat to the growth that we are seeing at the moment in that really unusual recovery. I would mention two of them. The first one is the supply bottlenecks and the disruption of supply chains, which we have been experiencing now for a few months, and which seems to be continuing and in some sectors accelerating. I'm thinking here about shipping, cargo handling, and things like that. And clearly, if we look at some of the exporting countries in the euro area, they would have been able to export much more goods than they have because of these issues. How long those bottlenecks will take to be resolved and to fade out remains to be seen, and I think it's one of the question marks that we have on our radar screen. The second point that I would like to mention, because the euro area is a net importer of energy, is the significant increase in the price of energy pretty much across the board, led obviously by gas, by electricity, by oil to a certain degree as well. But those are sort of base effects of what we saw last year, which was a major decline of those prices. And we'll see how long it takes for that to fade away. It should go out in the first part of 22, but those are two uncertainties. And I would mention the last of the uncertainties that we have to account for as well, and that is potential new waves of a pandemic that would be vaccine resistant and that would lead governments and policymakers to yet again go back to containment and lockdown measures. It doesn't seem to be the case at the moment, but winter is coming. We know that these variants are particularly contagious in times of colder weather than what we have now in Frankfurt.
Great. We'll certainly be talking about all of these threats. But let me turn to you, Governor Bailey.
Thank you. I want to start with some of the successes of policy over the last 18 months. And I think there are three things I want to draw out. One is that we are seeing, I think, we've seen a very substantial attenuation of the economic effects of COVID. Secondly, and consistent with that, the impact of the COVID shock on household incomes, on employment, and on the viability and health of businesses has been a lot less than I think we feared it would be going back to the spring of last year. And thirdly, policy in the broader sense, because there are clear monetary and fiscal policy, has played a very important part in achieving that. So relative to where we were when we spoke a year ago, we are, I think, we have substantial success to look at. Now, the recovery is uneven. That's not surprising because we've had both a shock to demand and a shock to supply, both are recovering. We tend to call it, two big moving parts. To give an example, I agree with Christine about service sector recovery, but we've still got to, certainly in the UK, we've still got to see some shift from goods to services. And maybe that would happen. But again, that is affecting some of the relative balance of demand and supply. As Christine said, we are seeing bottlenecks on the supply side. Some of those are global in nature. Some commodities, microchips, some of them are specific. Believe it or not, we've been rather short of wind in Britain in recent months, over recent week or two, to generate power. I find that quite hard to believe, but it's true. Now, I expect all these things to be temporary. I haven't changed, nothing I've seen has caused me to change my view on that. That continues to be my view. So I think we face two issues now with that diagnosis of the supply shocks being temporary. One is how the labour market is going to evolve, and particularly the supply of labour. And secondly, as we go through this hump of inflation caused by this relative balance of supply and demand and the effect of some of these bottlenecks and supply shocks, how it might affect inflation expectations, because of course it is important that we keep those anchored in the medium term to the policy framework that we have. So we are seeing some weakening of the pace of recovery, but I agree with Christine's assessment that I think, while we're not completely out of the water, I expect us to be back to pre-pandemic level, certainly in the early part of next year, possibly, a month or two later than we thought we would be over the summer, but we're still heading back there. So we need to guide through that in terms of what I said, particularly the labour market supply and keeping a very close watch on inflation expectations. Thank you.
Great, thank you. And again, issues that we will be discussing further over the next 45 minutes. Chair Powell, can I turn to you then?
Thank you. It's great to be here. So I guess I'll start by noting that the outlook, while I think quite positive in the medium term, is highly uncertain. And one of the main reasons for that is just that this expansion is quite unusual and actually very different from the normal pattern. So what we have now is very strong demand, quite strong demand on the back of strong fiscal policy, strong monetary policy. In the United States, fiscal policy more than fully replaced lost incomes. So typically at this phase of an expansion, we'd be supporting aggregate demand with our monetary policy to try to get back to a full level of economic activity, and that's not the situation now. Demand is strong. It's supply side constraints that are really holding back the economy at this time. So quite unusual. And as I guess Christine mentioned, the demand is really in the goods sector rather than the services sector. So usually the services sector would be okay in a downturn and goods would be sharply cyclical. We have the opposite. So the playbook for what to do and how to think about this is quite unusual. Turning to the United States for just briefly, very strong demand with the support I mentioned. Household and business balance sheets quite strong. Demand in the first half and results really strong. A lot of people getting back to work. Over the last couple of months, the Delta variant has held up progress, keeping people from resuming public activities in the travel and leisure sector. Job growth slowed sharply, and estimates of third quarter GDP have come down, albeit still to strong levels. Bottlenecks and tangled supply lines are holding back activity in some goods, particularly automotive. And the combination of strong demand for goods and the bottlenecks has meant that inflation is running well above target. And we expect that it will continue to do so in coming months before moderating as bottlenecks ease. So the outlook, as I mentioned, is for strong demand to return as Delta cases continue to decline, bringing faster progress toward full employment. It is frustrating to acknowledge that getting people vaccinated and getting Delta under control 18 months later still remains the most important economic policy that we have. And it's also frustrating to see the bottlenecks and supply chain problems not getting better. In fact, at the margin, apparently getting a little bit worse. And that's what we see that continuing into next year probably, and holding inflation up longer than we had thought. But ultimately, the outlook for next year among my colleagues and me at the Fed for next year is quite a strong year with growth well above trend and unemployment reaching significantly lower levels than now. Thank you.
Thank you. So it is quite interesting that uncertainty is still a part of the lexicon here a year later. But let's delve into inflation. You have all raised it. Sticky issue. We've seen a rise in inflation as economies have rebounded. As you have said, energy prices have spiked. Supply chains are being disrupted. Shipping costs are soaring. All of you, or rather the Federal Reserve, the BOE, and the ECB, have all characterized this as transitory. But history would suggest that temporary inflation, if it goes on long enough, becomes permanent. And we have spoken, we at Reuters have spoken to policymakers who privately express more anxiety about the stickiness of this inflation and, of course, the effect it could ultimately have in dampening growth and therefore hurting the livelihoods of people whose lives have already been upended about the pandemic. So let's talk about that a little bit. Chair Powell, your own forecast suggests that inflation is stickier than the word transitory would suggest. Should central banks start acknowledging that we have basically let the inflation genie out of the bottle?
Well, let me explain what we mean by the word transitory. So for some time, we and others have been forecasting that inflation, the current inflation spike, will not lead to a new inflation regime in which inflation remains high year after year. In other words, that is what we mean by saying that the spike will be transitory. We don't mean that prices will come down. What we mean is that this inflationary spike will not lead to a new regime of ongoing higher inflation. As I mentioned, economic forecasters and pricing in financial markets are well aligned with that perspective. And why is it our perspective? It's really because the current inflation, as I mentioned in the beginning, the current inflation spike is really a consequence of supply constraints meeting very strong demand. And that is all associated with the reopening of the economy, which is a process that will have a beginning, a middle, and an end. And we see those things resolving. It's very difficult to say how big the effects will be in the meantime or how long they will last. But we do expect that we'll get through that. Now, Alessandra, I think you identified exactly the right risk is if this period of higher inflation, even though it ultimately is very likely to prove temporary, if it lasts long enough, will it start changing the way people think about inflation? And we monitor that very, very carefully through a number of different lenses because we think that is quite important. And we do not see evidence of that now, but that's quite important. And so, of course, if we were to see sustained higher inflation and that were to become a serious concern, I will tell you the FOMC would certainly respond and we would use our tools to assure that inflation runs at levels that are consistent with our goal.
Thank you. President Lagarde, in your speech yesterday, you seemed to give more emphasis than you had given before to the upside risks of inflation. I was wondering whether you could flesh this out a little bit for us.
Well, I tend to agree with my colleague Jay Powell in considering that the price increase that we are seeing at the moment is largely attributable to the reopening of the economy. So whether you look at energy prices, whether you look at some VAT aspects in the euro area, particularly in Germany, whether you look at some prices having to do with sales, all of that is base effects, and it's, the economy reopens, it went down during the lockdown period, it's going up, but on average, we are pretty much back to where we were in 2019. Now, just like what Jay was saying, we monitor very carefully the possible impact that lasting transitory price increases could eventually have. And in particular, we are very attentive to inflation expectations and making sure that they remain well anchored. Well, when we look at that using a variety of instruments to measure those expectations, we see that they went up by about 50 basis points, but they're still at a distance from our 2% target. The second aspect that we look very attentively at is the wage increases and the wage negotiations that are going to reopen in the euro area. At the moment, we are certainly not seeing any widespread contamination, so to speak, of those price increases into wages that would produce the second round effect that we would be very attentive to. So we monitor carefully, but we certainly have no reason to believe that this price increases that we're seeing now will not be largely transitory going forward.
So if I can just follow up, does that explain then why, to a certain extent, your assessment and that of your colleagues here is similar, but the conclusions with regards to the Eurozone as to upcoming policy changes is different? Because, of course, Governor Bailey and Chair Powell have made, clear indications about possible rate hikes down the line.
Well, we started in the euro area from a different base. We are at different interest rates. Ours are certainly for the DFR negative, and we have asset purchases that are underway and will continue to be so until we are confident that we reach the level that we have set for ourselves. So we start from a different base. Our inflation levels at the moment are different as well. But we have a very clear roadmap, and that is our forward guidance, which we have revamped and communicated upon back in July, which is our roadmap going forward in order to reach our target, which is that symmetric 2% that we defined for ourselves. that forward guidance is very clear. We need to be at target well before the end of our horizon. It has to be lasting until the end of our horizon. And third, we have to be content and satisfied, Governing Council of the ECB, that there is sufficient progress in the underlying inflation so that it will be sustainable in the long run. So that's probably the reason why we are at a different pace in our monetary reaction function.
Governor Bailey, what is happening in the UK? We are in a global panel here. I, of course, live in London, but, you know, what is happening? You see queues at the petrol stations, you know, lorry shortages, supermarket shelves empty. What is happening, and what effect will it have on the UK economic recovery?
Well, I mean, it's a form of the supply side shocks that we've all been talking about. You know, we have had a number of, frankly, shortages and supply side shocks, which don't have a common cause, I would say. And I think it's important to emphasise that. Some of them are global, some of them are domestic. I think they have different origins. I mean, it's interesting. You mentioned the petrol station queues, which I do think now there's some evidence. You know, they are now. I think we may be past the peak of that, actually, because we're not actually short of fuel. It was the capacity and the drivers to deliver it, actually, that caused this. And I think there's evidence that is now correcting itself. Now, you mentioned this point about where's the boundary, if you like, between transitory and sticky. No, I think that depends on the nature of the shock. I don't think we should think that transitory has a fixed time point in it for all shocks. I mean, the shape and the dynamics of these shocks will be somewhat different. But if I could say, I mean, picking up on what Christine and Jay have said, I think for me there are two things that really stand out here in terms of judging these effects. One is, as I said, how it's appearing in the labour market. You know, we've got a very obviously important development tomorrow night, actually, in the UK, because the so-called furlough scheme comes to an end at midnight tomorrow night, and that will have an important, I think, role in shaping how the labour market and how labour supply relative to demand evolves. And the other one is the evolution of expectations, and I mean, that is where I think we have to be very focused in terms of policy. But I would emphasise a point I've made a number of times: monetary policy can't solve supply side shocks. You know, monetary policy can't produce computer chips, it can't produce wind, can't produce truck drivers. That's not something we can do. What we have to do is focus on the potential second round effects from those shortages.
Can I just, you mentioned the furlough program, and as you said, there's still time to understand, right, what happens after the end, the impact of the end of the furlough program. But have I understood correctly your recent comments? In which you're saying that there's no reason the BOE cannot start to raise rates before it has finished quantitative easing at the end of this year. Are you trying to message that you're considering raising rates maybe at the November or December meeting?
Well, I'm not going to prejudge. Our next meeting is the beginning of November, and obviously, as you'll understand, I'm not going to prejudge what we will decide at that meeting. That's not for now. I think what we're very clearly saying is, I mean, as I'm sure you know, our quantitative easing program is somewhat different from some other quantitative easing programs, because it has a fixed length of time and a fixed amount, and that length of time is actually almost up when it finishes in the middle of December. So it is now in its final stages. I mean, talk of tapering is rather different in our case because it naturally tapers off. And the point that I and others have made is that when we consider policy in the round, as we do, and particularly with the asset purchase scheme now coming towards its end, we do look at all the tools at our disposal. And we have said a number of times, and I think this is an important point to make, that when we come to decide to change policy, the preferred tool will always be rates, because we understand the effect. The effect of rates in the monetary transmission mechanism is much better understood. They are the primary tool, I think, of central banks. Certainly, I can say that for the Bank of England. But that's not to prejudge what we will decide in November.
And just the last thing, because again, it's a global audience here. How much of these problems, of these supply problems, are COVID? How much are they Brexit? And don't answer Brovid. The answer I'm looking for is not Brovid.
Well, actually, you know, the interesting thing is they're not just those two, actually. I mean, we can't, I think, we certainly can't attribute the lack of wind power to either of those two. I don't think the semiconductor chip issue, it may have some connections to COVID, but I think it's got other causes. So when you look at each of these shocks, you'll find different things at work. Now, as I think Christine was saying, I think, and Jay, COVID, I think certainly has had quite an influence on, or has been the big influence on the shipping issue, for instance, because it's caused this, you know, this imbalance of supply and demand. It's disrupted shipping flow, as it were, over time. So I think that one can put down, you know, a lot of that to shipping because to COVID, and also because, by the way, it's a global market. It's not just a European market.
Okay, all right, thank you. Governor Kuroda, Japan, of course, is in a different situation, which you talked about. Consumer inflation stuck at zero, raw materials costs are rising. So I did want to pick up the supply disruption issue with you. Factory shutdowns caused by the pandemic are triggering shortages that are affecting global manufacturers, including Japan's. Could Asian nations lose their role as the global parts production hub? And what would that mean?
Yeah, maybe before going to that issue, let me explain a little bit about the price situation in Japan. As you said, currently core CPI inflation is around zero. But it has been pushed down by more than 1 percentage point by mobile phone charge reduction alone. So excluding temporary factors like this one, the underlying inflation is not so weak as the headline figure. But two facts. One, certainly the Japanese economic recovery is somewhat lagged behind US or European economic recovery. But more importantly, during the pandemic recession, the Japanese firms retained employment. Actually, the unemployment rate before the pandemic was around 2.5%. And the worst unemployment rate was 3.1% last October. And currently, unemployment rate is 2.8%. So despite huge decline of economic recoveries, economic activities, and now recovery, the employment was retained by Japanese firms. And so even if the economic recovery starts and in coming months it would become stronger, but inflation acceleration is unlikely. So there's no kind of speed limit in that sense. Now, supply disruption in Asia, there are two factors. One, semiconductor supply shortage, but that is more or less, if not solved, but become less important as far as the Japanese economy is concerned. But then, in recent months, as you may know, some Southeast Asian countries have suffered from huge increase of COVID-19 infection, and some countries imposed severe lockdown, even closing various factories, so that the procurement of various parts, particularly of automobile parts, became quite difficult for Japanese automakers. So certainly this kind of supply disruption has been affecting the Japanese economic recovery somewhat, but I think these are anyway transitory, temporary, and I would say that within the next couple of months, or this kind of supply chain disruption would be somewhat reduced. But on the other hand, we can see, as I said at the outset, the demand for IT-related goods and automobile-related goods, demand are increasing globally very rapidly, so that this is what I say. Demand is recovering and increasing so rapidly that supply chain cannot fully follow the increased, rapidly increasing demand. So this is not the usual sort of supply chain disruption, disruption caused by earthquake or flood or fire and so on and so forth. So this kind of another supply chain, I don't say disruption, but somewhat lagged response of supply to rapidly increasing demand. And this is likely to be prolonged somewhat.
Governor Kuroda, I want to come back actually to the disruptions that you just mentioned, climatic disruptions, but I wanted to turn to financial stability. Of course, you are all paid to worry about financial stability, and we learned a decade ago that what starts in financial markets doesn't stay in financial markets. And a live risk right now is the Chinese regulatory crackdown and the broader downturn in China's real estate market. So, Governor Kuroda, if I could start with you, some suggest that China's growth has been driven by this red-hot property market, and that what is happening now is actually similar to what happened to Japan in the late 1980s. And of course, we all know what happened when that bubble burst. So, is China's bubble about to pop? And if so, what happens next?
I think the China's real estate problem is somewhat different from the problem we faced, as you said, toward the end of 1980s or early 1990s, or the subprime loan problems faced by the US in 2008. Because one, there appears to be, what I say, extremely speculative investment in real estate market does not appear to be the case in the Chinese case. Of course, Chinese real estate market has been expanding quite long time, and currently the Chinese authorities are taking various measures to what I say, contain the excessive speculative investment or excessive expansion of real estate activities. But I think at this stage it's quite unlikely this problem would sort of proliferate and affect the entire Chinese real estate market or even the entire Chinese economy. I don't think it's likely. And then, of course, international what do you say impact. Of course, is another thing. But as far as I can see, probably this is also the case in the U.S. and Europe. As far as the Japanese financial system is concerned, the direct exposure to a particular real estate group or even the entire Chinese real estate market is quite limited. So
you've said
I don't think it's quite.
Yeah, you have set
I
our
don't
mind.
think it's likely to be a big financial crisis emanating from China to the world. That's unlikely, I think.
Got it. Well, now that you've set our mind at ease about that, then let me do a quick lightning round on what are the biggest risks to financial stability then. President Lagarde. and then we'll go Chair Powell and Governor Bailey.
Well, in addition to all the sort of traditional financial stability risk that we can think about, I would like to mention one which is high on my mind and maybe far on the horizon, but which could have financial stability bearing, and that is if we are to completely ignore the consequences of climate change on the work that we do, on the assets that are held, and on the transition that we plan going forward. I think that's a risk to financial stability. Now, in addition to that, you have cyber risks, you have, repricing of assets in brutal conditions. You have all the traditional ones, but the one that is associated with climate change is one that is important, and as previous panel demonstrated, really needs to be further explored and prepared for.
Chair Powell, I would like an answer to the main question, but actually what President Lagarde said is very interesting, because in the past two panels ago, I don't know if you all were listening, but one of the participants indicated that one of the reasons that central banks have made errors in forecasting inflation is because they are not taking into account climate change enough, and that basically targeting should be no longer based around inflation, but other indicators for this reason. So, Chair Powell, what if you could address that, and then quickly, and then your risks for the financial stability.
Tell you what, I'll do it in the reverse order. I had three quickly that I wrote down. One is a successful cyber attack on a large financial institution or financial market utility. The second is just the structural problems that we saw in markets during the height of the acute phase of the pandemic. This is short-term funding markets, the treasury market. We're working on fixing those, but those were revealed, and I think we need to fix them. And then longer term, I would agree that both physical and transition risk from climate change for financial institutions. So turning to your question on inflation, I mean, I think the blue chip forecast for 2021 inflation in the first quarter of this year for the full year was about 2%. So what people didn't see coming was the supply side constraints. And no one forecast that. And there are very few people, if they did, forecast that. So that was a surprise. It's not that our inflation models are wrong, although they certainly are not perfect, but just the sort of scope and persistence of the supply side constraints were missed. I wouldn't say that climate change is a particularly important aspect of the inflation forecasting story for 2021, although that's quite an interesting hypothesis.
Okay. And Governor Bailey, on the biggest risks to the financial system.
Well, I'm afraid I don't have unique ones. Well, actually, it's probably good news I don't have unique ones, just to pile even more on. I would highlight two that I think Jay and Christine have already mentioned. So first, I would highlight cyber. I probably slightly disagree with Christine. Yes, it's been around for a while. I'm not sure I'd quite call it traditional in the sense that actually I think it's the risk that has gone up the, unfortunately, up the league table very rapidly, keeps evolving, and we have to take an approach to that we will never be rid of it in a sense. We have to keep acting on it for the reason that the threat just keeps, if you like, developing, emerging, and changing. And it has certainly, I'm afraid, sadly gone up the list yet again in the last year. The second one I would say, as Jay highlighted, is the stress that we saw in funding markets and in the non-bank financial world, particularly going back to spring, March of last year, where we saw not only a stress in that world, but also the capacity of that stress to have financial stability and broader systemic implications. We saw what we might call core markets, as Jay highlighted, being affected by that. And certainly when you look at the work that we're all closely involved in the Financial Stability Board, the Global Financial Stability Board, that is a very key point of focus in the work of the board, and rightly so.
So I'd like to turn for a moment on the pandemic response, lessons learned. One of the notable successes, of course, of the pandemic response has been the perhaps unprecedented coordination between monetary and fiscal policy. And clearly this cooperation was justified in the middle of a financial crisis at the time, more recently because of a global virus, zero interest rates. But I thought we could talk a little bit perhaps about long-term risks of this. Chair Powell, the past 18 months have proved that, as we were saying, fiscal and monetary policy can pull us out of a recession. But the textbooks also say that when the economy is revived, that has to pull back. And yet, in Congress right now, much of the conversation is about more spending, not about the deficit. So I guess, and you yourself have indicated that interest rates are going to remain very low for a lot longer. So I guess my question is, are you overdoing it?
Well, I don't think so. So a couple of points. First, in the United States, GDP has now surpassed its prior peak, and it's on its way to exceed its prior trend, which is a remarkable success for policy. By any reckoning, this was a historically successful response from both fiscal and monetary policy. It's also worth noting that there's good reason to think that fiscal policy is particularly effective when monetary policy is pinned at the effective lower bound. Not only does the effective lower bound for interest rates not bind fiscal policy is actually more effective at the ELB because longer-term rates will go up less as the economy strengthens. I would characterize them as complementary rather than coordinated. Monetary policy works by stimulating aggregate demand with a lag, but the pandemic threw 25 million people in the United States out of work overnight. What was needed was massive and immediate replacement of lost incomes for households and small businesses, and that's what fiscal policy did. So we really worked in parallel rather than in collaboration. The place where there was collaboration was with the various lending facilities, and this also happened in other jurisdictions, which are only available to us in a declared emergency involving unusual and exigent circumstances. That really worked as well. We worked very closely with Treasury. We're unwinding all of that, and we're going back to separate roles. And I think it's important to go back to observing those institutional lines. In terms of overdoing it, I think the historical record is thick with examples of underdoing it. And pretty much in every cycle, we just tend to underestimate the damage and underestimate the need for a response. I think we've avoided that this time. And in particular, fiscal policy was so fast and so forceful here. And we tried to do the same here. I think, as you know, we are at a place where we're getting close to achieving substantial further progress since last December toward our goals, which would enable us to then taper our asset purchases. Raising interest rates for us is a ways off because we have a substantially higher test. but about half of the FOMC believes that that test will be met by the end of next year, and 8 of the 9 remaining members believe that it will be met in 2023. So we definitely responded strongly, and I think we're turning to the process of normalization in a careful way, and I like to think that's the right way to do it.
President Lagarde, Chair Powell rightly talked about re-erecting the sort of the red lines, the red institutional lines. But in the Eurozone, can we actually wean central governments off of central bank cash?
You know, I was listening very carefully to Jay, and there was a lot that I could actually just echo and subscribe to in terms of the relationship between fiscal and monetary authorities, fiscal and monetary policies. And I think what has been exceptional compared with previous major crises is the fact that we worked in a very complementary way. And what is specific to the euro area is the ability of the 19 member states, actually the 27 member states of the European Union, to, for once and for the first time, get together, decide to borrow jointly, and to support each other in an asymmetric way, in the sense that those countries that were most affected are going to benefit from grants more so than loans. And that is under this Next Generation European Union Fund facility, under which each of the member states is accountable to the rest of the group to actually do some structural reforms to be eligible to those funds. But I would completely agree with Jay that, you know, once this pandemic crisis will completely recede, and we're not completely at that point yet in the euro area, each of the two policymakers, fiscal on the one hand, monetary on the other hand, should continue to secure and preserve its independence and continue to deliver under its mandate. For us, it's price stability, and this is what we have to stick to.
Governor Kuroda, today's news, of course, is that Japan will soon have a new prime minister. Do you expect a change in relationship between your bank and the government?
As you know, just today, the new president of the LDP was elected, and next Monday, probably the extraordinary parliamentary session would start, and then the new prime minister would be appointed or designated by the parliament, and then he would form his cabinet next week. What kind of policies the new government would pursue, I don't know. But as far as the economic situation is concerned, I think not only the government, but also the Bank of Japan continue to support the economic activities. And of course, policy cooperation between the Bank of Japan and the government is made while clearly differentiating their respective roles. For instance, the bank has provided liquidity to support corporate financing, while the government has provided credit guarantees and equity support. And in addition, of course, the Japanese government has expanded its spending substantially, while the Bank of Japan has maintained a low interest rate under the so-called yield curve control, resulting in some positive synergy effect or policy mix effect of these policies. So whatever kind of fiscal policy or regulatory policy or any other policies the new government, the new cabinet pursue, we at the Bank of Japan will continue to maintain extremely accommodative monetary policy in order to achieve the 2% price stability target as soon as possible. And this is our mandate. And that mandate is not likely to change. And also, as I said, the current inflation rate is still around 0, although the excluding temporary factors, inflation rate is quite positive, but still far away from the 2% target. And so we will anyway continue our current accommodative monetary policy, yield curve control, and if necessary, we would further ease monetary conditions. Of course, this is as necessary or if necessary. So I don't want to go into the political kind of comment.
Okay, we'd welcome it if you did, but all right. Listen, Governor Kuroda, I have another question on another topic. I wanted to switch to cryptocurrencies and the development of central bank digital currencies, which is clearly an important one. Governor Kuroda, do digital currencies threaten to or threaten the supreme role of the dollar as the international currency?
I think that should better be answered by Chairman Powell rather than me. But I can say that the status or the role of the U.S. dollar as the most important international currency is not likely to change, even if there's some CBDC or digital central bank currency outside of the United States. And anyway, I think you have to differentiate three things from each other. One is so-called cryptocurrency or something like that, like Bitcoin or whatever. And second is stable coin, which is a money issued by private banks or private concerns, but closely linked to the central bank currency, so that the value is stable, fixed, so that stable currency. And then CBDC, the digital central bank currency. And as far as so-called cryptocurrency or crypto asset is concerned, I don't think it would have any serious impact on our monetary system. But on the other hand, certainly stable coin could have some impact on the financial system through which the central bank operates monetary policy, so that naturally we are very much interested in or even concerned about what kind of stablecoin development is likely to take place.
Let me stop you there, just because, I mean, Chair Powell, Governor Kuroda asked you, lobbed a question at you. So we feel that we need the answer, and I will add my own, which is China going to beat you to it when it comes to introducing a digital central bank currency? How fast will the Fed move?
We'll answer that question, but I would first like to note that the comments I made earlier about doing too much, overdoing it, I can really only stand in judgment on monetary policy. I would never comment on fiscal policy or current fiscal policy discussions. So I guess I would say it's very important that we as central banks maintain a stable currency and a stable payment system for the public's benefit. We're seeing transformational innovation around digital payments, and we at the Fed feel like we need to assure that we can continue to deliver to the public a stable and trustworthy currency and payment system. So there's essentially myriad private currencies and currency-like products popping up all over the place. And we are working hard to evaluate whether to issue a CBDC, and if so, in what forms. And I would say we're doing quite a lot of work on the policy issues, which are quite significant, and also the technological issues, which are quite significant. And the question at the end of the day for us will be whether this is something that would serve the public well. And something we're looking at quickly, I know we're running out of time, but we are going to publish a paper in the not too distant future in which we lay out our preliminary thinking and seek comment from elected representatives and various interested parties as we work to. So we want to be in a position to make a well-informed decision on this within a couple of years. And I would have thought that that's timely. It's better for us to do this right rather than try to do it fast as the world's reserve currency. But nonetheless, it's an urgent matter because digital innovation is moving very quickly. As Haruhiko pointed out, stable coins can be very popular, and they exist mostly outside of the regulatory perimeter, which we need to be very careful about because this is the public's money that we're talking about. They look a lot like bank deposits or like money market funds, but without the regulation. So this area is moving so quickly that there is a sense of urgency in wanting to push ahead.
Great, thank you. Now, we're going to do a last round, which is I'm going to cite back to you the biggest, the thing that worried you the most last year, and I'm going to ask you whether those fears were justified. But before we do that, I must ask you, Chair Powell, you've had a tough last couple of days. Two of your closest associates have resigned. You've been called a dangerous man. You know, very soon you could go back to riding your bicycle in your beautiful country. And do you want a second term as chair?
You know, I'm going to continue my long practice of not commenting on this. My focus is on doing my job every day. That's enough to keep me more than adequately busy. So I won't have a comment on that for you.
All right, then the last lightning round is last year, when you were in this panel, you were asked what was the thing that worried you the most. And I'm going to cite back to you what you all said. Governor Kuroda, obviously, you were not here. But so, Chair Powell, you said that the thing that worried you the most was that there was a longer run, that there could be a longer run change in productive capacity and that people's lives would worsen. So I would ask, I'm going to come back to you for that, but just think about that. And the top line seems to suggest not, but I would ask you whether that fear is justified. And then what is your biggest worry now? Governor Bailey, you evoked the biggest shock for the UK since the early 18th century. And you said what frightened you the most was the uncertainty and unpredictability of the moment. So do you feel that fear was justified? And what is your biggest worry now? And President Lagarde, your biggest worry at the time, let's remember, to give it context, we were still at the height of the pandemic, and you were worried about minks. Now, of course, what you meant was the transition to minks, the animal, and then, the transmission from man to mink back to human. And then the hubris, you said, that might lead us into another world conflict. So we'll ask you as well if those fears were justified and what keeps you up at night now. And then, Governor Kuroda, you were not here. I don't know what you were worried about last year, but I'm going to ask you then first, what are you worried about today the most? And then we'll go to Governor Bailey, to Chair Powell, and we'll end with you, President Lagarde.
My short answer is economic recovery, which has already started. But still, consumption is weak, while investment is strong. So what I'm concerned about is when the economy is fully recovered and grow fast. I think that is my concern, my interest. Of course, in the future, in coming years, we must achieve 2% price stability target. That is true. But at this moment, economic recovery, faster growth is the most important challenge faced by us.
Got it. Thank you. Governor Bailey.
Well, I think it's interesting to be reminded of that, because I think that was my comment about unpredictability and uncertainty a year ago, of course, was interesting because it was very much in the context of a COVID world, but a world we were pre-vaccination at that point. We were pre-vaccination and the proof of the sort of the success of vaccination. That's been a huge change and success. And so I think in a sense, one source of uncertainty, it's now moved on. And as we were discussing earlier, I think for me, the big challenge now is that we can get through this period of uneven growth, of supply side disruptions and bumps, and come out on the other side with both, a much sort of smoother recovery and balance of supply and demand. And also, I would say then, addressing the sort of the underlying structural issues which will determine the rate of growth, the trend rate of growth of our economies. And Christine's pointed to climate change. That's a big one as well going forwards.
Great, thank you. Governor Bailey, just quickly, what do you expect from COP in Glasgow?
Well, I hope it will actually really cement, I think, the very real progress we've all been working at this year in a number of areas. So I think particularly in the solid transition plans of many companies, many parts of our economy, that will be backed up by much stronger disclosure, much stronger monitoring, a much more robust system. And that will allow us to understand how it's going to go forward and the macroeconomic path that we will be following. So that's what I hope will come out of it. Plus, of course, I think we need to see support for the emerging world. We need to remember that we've got to support this. Climate is by definition the ultimate global issue, and therefore we need to see support for all parts of the world.
Thank you. Chair Powell.
I've not seen the labor market scarring or the mass failure of multi-generational small businesses and the loss of all of that great human capital and economic capital. And I'm very, very pleased that that's an enormous success for policy. There are still workers who are going to need support in various forms. It's not a perfect world out there, but we avoided the really serious concern that I had. Looking forward, the big concern is this. This is not the situation that we've faced for a very long time. It's one in which there's a tension between our two objectives, maximum employment and price stability. Inflation is high, well above target, and yet there appears to be slack in the labor market. At the same time, there are other indicators that suggest that by some measures, the labor market's very tight. So managing through that process over the next couple of years, I think, is the highest and most important priority. And it's going to be very challenging because, we have a hypothesis that inflation is going to be transitory. We think that's right. But we are concerned about underlying inflation expectations remaining stable as they have so far, approximately. So that's what I see as the big challenge for us in the next, call it the next couple of years.
Great, thank you. And lastly, President Lagarde.
Well, I'm going to mention some hope, actually, because I'm convinced that between us, we are going to do our job. We're going to be focused on our mandate. We're going to use the tools we have. We have our roadmaps. And we are accountable to the public that we want to serve as best as we can by making our institutions fit for what's needed, which, as we have discussed, has to do with, being digital, being greener, being on mandate. But my hope is the following. We've been very badly hurt, and we managed to recover very fast, but we've been very badly hurt by something that just fell on all of us, that was this pandemic. And my hope is that we have the common sense to see what unites us, and that is our humanity. And if we leave by the side of the road 1 billion people not vaccinated, and if between all of us policymakers, and that is more addressed maybe to governments than just to central bank governors, we cannot find the means to help those people be vaccinated properly, then not only are we not helping part of humanity, but we're not helping ourselves. So I really hope that between the G20 and between further efforts that will take place soon, maybe in Washington, and the Italian presidency, we can find a way to help those who need vaccination if they are protected and if we are protected.
Thank you. Well, on that message of common sense and humanity, who can argue with that? I will close this panel. Thank you so much to all the panelists. You have been absolutely brilliant. We have gone a little bit over time. I apologize for that. Over to you, Claire, and thank you again.
Thank you, Alessandra, for doing such a fantastic job in moderating what's proven to be a very insightful final panel for this year. I'd like to thank the participants too, not only for today, but for the decisive action you took during the early days of the pandemic. It seems that there's certainly areas of common agreement still. There's a sense that inflation is transitory, that most of the problems are on the supply side, that demand is relatively strong. However, in terms of how our policymakers react to the environment, as Alessandra rightly pointed out, there seem to be some areas of divergence. Earlier today, Politica referred to our panelists as the Fab Four. It seems, for the purposes of policy at least, the Fab Four are splitting up.